This is a story about an empire, an institution a century old, built on the idea of trust. And this is the story of how that empire gambled everything and in a single night vanished from the face of the earth. This is the fall of Washington Mutual. The end begins on a Thursday, September 25th, 2008. You have to remember the feeling in the air back then. Pure panic. Bear Stearns was a ghost. Lehman Brothers had just evaporated, and a financial hurricane was bearing down on Seattle.
That night, the doors to Washington Mutual's headquarters open, and federal agents walk in. They're not there to talk. They're not there to offer a bailout. They are there to seize the bank right now. Now, to understand the shockwave this sent, you need to grasp the sheer scale of the operation. This wasn't some little community bank. We are talking about an institution with over $307 billion in assets. A giant. And in the space of a few hours, it was gone, just erased. The biggest bank failure in American history. And it all leads to one single question. How does a titan like this collapse so completely, so fast? To find the answer, we have to go back, way back. See, for most of its life, Washington Mutual, or WaMu as everyone called it, was the exact opposite of a high-flying risk-taker. Its entire identity was built on being safe, on being trustworthy. I mean, look at its history. It was born from the ashes of the Great Seattle Fire of 1889, literally helping people rebuild their lives. It stared down the Great Depression and didn't blink, while thousands of other banks folded. For 100 years, WaMu was solid, dependable, maybe even a little boring, and that was a good thing. This was their promise to the world, the friend of the family. And it wasn't just some clever marketing slogan. It was who they were. It was a promise. But a promise is a fragile thing. The change begins in 1990. A new CEO, Kerry Killinger, takes over, and he has a vision that is anything but boring. He sees a chance to turn this quiet neighborhood bank into a coast-to-coast behemoth. And just like that, everything starts to shift. The old WaMu, the one focused on community and stability, was being replaced. The new goal, to become the Walmart of banking. That meant one thing: aggressive, relentless growth, all fueled by home loans. And the weapon they chose for this war was something called the option arm. It sounded great to borrowers. You could choose your own payment. You could even pay so little that it didn't cover the interest. The problem? The unpaid interest was just tacked onto the loan. So every single month, your debt was actually getting bigger. They weren't just loans, they were ticking time bombs. And WaMu sold millions of them. To sell that many loans, you have to abandon your standards. And they did. This quote, which reportedly came from inside the bank's loan machine, tells you everything you need to know. The pressure to just say yes was unbelievable. Proof of income? Optional. Credit checks? A formality. The friend of the family had become a loan factory, working 24/7. And for a little while, the gamble looked like genius. From the outside, WaMu was an absolute powerhouse, a true American success story. By 2006, the numbers were just incredible. A stock price of $45, a market value of $40 billion, 2,300 branches across the country. They were everywhere. They seemed invincible. But inside the empire, it was a very different story. The bank's own risk management teams, the people paid to see disaster coming, they were screaming. They were sending up flares, warning after warning that the whole thing was built on a foundation of sand. But they were silenced, ignored. The profits were rolling in, the bonuses were massive, and no one wanted the party to stop. And then, in 2007, the housing market started to shake. And in 2008, the ground fell out from under everyone. The bubble didn't just leak, it burst, and WaMu's entire empire started to burn. Panic is contagious. And in the digital age, it moves at the speed of light. Customers started pulling their money out. In a terrifying 10-day stretch, they withdrew $16.7 billion. It was a bank run, but without the lines down the block. It was silent, invisible, and absolutely fatal. WaMu was bleeding out. It was out of cash. The federal regulators saw it. They had to act. So on that night, September 25th, the FDIC moved in. The seizure was fast, it was brutal, and it was final. The financial devastation is hard to even comprehend. That very night, J.P. Morgan Chase bought the bones of Washington Mutual for just $1.9 billion. Think about that. A company worth $40 billion just 2 years earlier was sold for pennies on the dollar. And for the shareholders, nothing. Their investment was worth absolute zero. And behind all those billions was an almost unimaginable human cost. 43,000 people. 43,000 employees had a job on Thursday, and on Friday, they didn't. Their lives were turned upside down, just like that.
So, when you sift through the wreckage of this colossal failure, what do you find? What are the lessons buried in the rubble?
Well, it really comes down to four things. First, a blinding greed that put short-term profit ahead of long-term survival. Second, a stunning arrogance that allowed them to ignore their own experts. Third, a suicidal obsession with growth at any cost. And finally, a culture that became so corrupted it turned the friend of the family into a predator.
You see, in the end, the collapse of Washington Mutual wasn't some unavoidable act of nature. It wasn't an accident. It was the direct result of a series of conscious choices. People chose this path. They chose to chase the money. They chose to ignore the warnings. They chose to betray a century of trust.
And that leaves us with one last question. A question that this story forces us to ask. The fall of WaMu isn't just about finance. It's about what happens when an institution forgets its soul. It asks us, what is the real price we all pay? When a bank forgets that trust is something you have to earn,